So capital market stakeholders, we discussed that there could be two kinds. One is equity shareholders and other is debt holders, which is creditors or banks. Now, both of these are very important, of course, but there is conflict between the two. Why do you think there could be conflict between the two? Why do you think there could be a conflict in what equity shareholders want with the firm and what creditors or debt holders want with the firm? What could be a conflict between the two?
The amount of risk that the firm takes.
Yeah, for example, like, can you give an example?
Like that what you looking for?
I mean, like, can you like explain like how
Sure.
the risk would?
Yeah. So, for example, higher risk would usually earn higher returns, so equity investors would want that. But higher risk would be worse for lenders because there's a possibility that it could go
Default on the loan, right? Yes, yes. Yeah, exactly what Rick said. It's a correct answer. So, exactly as he said that, this equity shareholders would want the firm to take more risks because more risk would give higher return, right? But debt holders, lenders, or creditors like banks would not want the firm to take higher risks because they would want to first ensure that their money comes back, right? That the firm is able to return their loan, regardless of whether they get higher returns or not, right? So, take for example, who is a big equity shareholders? Let's say Elon Musk. How much do you think has shares in Tesla without agreeing? Like 10%? Yeah, a little more than 10%. I guess like 12 to 14%, something like in that range. So, going by his personality, I would assume that he likes taking risk a lot, right? So he would want the firm to take more risk, invest in technologies or decisions that would entail a lot of risk, as we have seen in the last 2 to 3 years, right?